Hey everybody, welcome back to our last panel of the day on the impact section of the Global DeFi Conference. Probably the one most people have been looking forward to, which is the from past to present, how traditional banks are keeping up. Comparing decentralized finance with traditional finance and, seeing what's changing. Definitely one I'm super eager to get into. To introduce our guests, the panel is going to be moderated by Miko Matsumura, general partner of Gumby Cryptos. Miko's having some difficulties getting in, so we might be a little bit late. Our speakers are Paul Dowding, founder of TapestryX, William Bill Verhalle, co-founder of QuickFi, Jan Lebbe, the initiative lead blockchain international payments at ING, and William Reilly, global head of CFI sales and strategy at ChainLink. So I'll bring them on now. Yeah, if you guys just want to introduce yourselves just while we wait for Miko, and I'll get out of the way.
All right, I'm Paul Dowding, co-founder of L4S Corporation, and Layer 1 protocol is TapestryX. It's designed for the capital markets and banking. It's a real-time, scalable, high-capacity Layer 1 protocol with double entry accounting. And one of the reasons we've got the speed of performance and functionality is because we found a way to synchronize networks without needing consensus or mining or federated validation. So, and we're interested in talking, we're at current discussions with digital exchanges and even legacy exchanges in the crypto and DeFi space to try and create a regulated solution.
I'll go. Hi, my name is William Reilly. Head of CFI at ChainLink Labs. CFI stands for centralized finance, as opposed to decentralized finance, which ChainLink has really made its name in. We are a data oracle provider, so we take real world data and put it on the blockchain for DeFi applications to consume. And we've been recently partnering with more centralized finance players as they start to adopt Web3 technology in a broader form.
Hi, my name is Bill Verhalle. I'm the CEO and founder of a company called QuickFi. We have a business that provides a platform for financing for banks to automate and fully digitize their business equipment finance units. So we finance equipment for the companies, small businesses to large companies that are acquiring capital equipment, transactions from about $5,000 all the way up to $5 million. And we do it in a digital way on a digital platform where business borrowers can authenticate themselves and credit score their business and upload an invoice and finance a piece of equipment that they're acquiring in a matter of minutes instead of days or weeks, which it used to take before. We have a small blockchain component in the app, and we're actively working with a number of banks in the US.
Okay, and last, my name is Jan Lebbe. I'm a initiative lead DLT for both international payments and DeFi within ING. ING is a GSIB bank, so a top 20 bank, a systematically important bank in the world, according to several sources, top 10 in blockchain. Myself, I joined the blockchain team about 5 years ago as an initiative lead of payments to optimize international payments via blockchain. Doing a mapping of the various initiatives, ING joins Utility Settlement Coin Initiative to create a multi-currency settlement platform on DLT supported by central banks. This turned into Finality. I used to be Steerco member for USC. Now I'm observatory board member for Finality, which aims to go into production by the end of this year. End of 2020, we saw the rise of DeFi. We wrote a paper initially about that, and afterwards I became the lead of DeFi to investigate how ING could improve its services via DeFi, or at least via some of the DeFi setups. You're muted, Miko.
Your microphone's not on. You still can't hear
You're
you.
muted there, Miko.
Decentralized finance, but not decentralized sound, apparently. Elvis has left the building. So.
How's that? Is that any better?
That's better, yes. Well,
okay, sorry about the technical kerfuffling. I've never used AirMeet before. It's always a challenge, new platform. So yeah, so appreciate everybody's forbearance. So let's kick this thing off. So, I really feel like right now, we're really thinking about this, main topic, which is, how are the traditional banks keeping up? I think, it's definitely a pressing question. I think DeFi people are looking for a catalyst. I went to a event and, the keynote speaker was Stani from Aave, and they're doing Aave Arc, right? But, one of the things that's complicated about Arc, which is sort of a DeFi moving CeFi, or TradFi, is that, it doesn't really solve people's problems with respect to kind of KYC. And so, like, in a sense, like the regulated entities can't really touch stuff like that, right? And then, the next speaker was Alex Mashinsky from our own portfolio company, Celsius. And, he's obviously talking about Celsius X, which is, CeFi going DeFi, right? So, just by way of introduction for myself, I'm a VC. We've done a lot of kind of investment into DeFi and CeFi. And so, we definitely have kind of a perspective on this, invested into things like 1inch and Vega protocols and, a number of kind of DeFi protocols, as well as, some CeFi players like Celsius Network. So, that's kind of my own sort of perspective around this space. I guess what I would love to do is just kind of kick it off from, really posing maybe a bit of a challenge, right? Which is that in a sense, it feels like traditional banks are kind of in a very clear regulatory, space. I think traditional banks, have considerable risk aversion, and obviously people are wanting to avoid, very punitive regulatory action. So, I guess my question is, can they keep up? Like, or are they going to have, are they, because to me, like the way I'm seeing the banks adapting is they're doing it by proxy, right? So, Goldman Sachs is invested into Circle, like, there are these arm's length relationships that seem to be the approaches that people are taking, right? Because then you have a regulatory firewall where you can always say the other organization's at fault, it wasn't us, but they can still be financial beneficiaries. So that's kind of what I've been seeing. I don't know if anyone else sees different.
Miko, I can weigh in on that one. This is Bill. I think maybe that's one of the reasons you asked me to be on this, even though my blockchain experience is fairly limited. We see that like our niche has been creating an end-to-end solution that banks can easily adopt without a tremendous amount of integration and a lot of complexity that raises technical challenges and potentially regulatory challenges. So I think we see that in the U.S. that either through acquisition or through partnerships with firms that can provide, end-to-end solutions is a way for banks to maybe put their toe in the water in a little bit more cautious way.
I think that makes sense.
I can also comment if you allow.
Yeah, go ahead.
Ma'am, what you say about Goldman Sachs, okay, investing in proxies, a lot of banks indeed do that. A lot of banks have a ventures team which are investing in the technology of the future to gain a lot of experience, to hedge themselves by missing out, maybe. But what you're saying, will banks be missing out? I think we are risk averse in a way that before putting certain products into the market, we need to make sure that the product is feasible from a technical point of view and from a legal point of view. We are a regulated entity, so we need to have regulatory certainty. But that is also what is blocking mass adoption. So if there's no regulatory certainty, if there's no technical certainty, currently you see a lot of risks, security risks in the market. If you do not have that security, if you do not have that regulatory certainty, mass adoption will not be following. So I think banks are missing out in the beginning, definitely. But taking into account that we are a regulated entity, that we do not want to take risks towards our clients, towards our customers, yeah, we're willing to wait and get first that reassurance about technical and regulatory feasibility before definitely entering. So
yeah,
go ahead.
Sorry. Yeah, I was going to say it's I can appreciate that, and that, you know, these banking organizations too, they take a lot of due diligence and time to even develop any type of new product and engage in a new market. So when we're engaging and working with banks on ChainLink, we are predominantly focused on proof of concept build outs with them, and this will be a multi-year process and vetting process, so they can, you know, be assured that there's a quality and level of service that they can provide to their end users, as well as stay in these regulatory guidelines and frameworks that are still being developed. And also too, when you see things in the market and DeFi with you know, multi-million-dollar hacks or hundreds of million-dollar hacks at times, this is also something that makes large institutional players rather hesitant to go headfirst into this new space.
Yeah.
I mean, I think
I can add. No. I was just going to add. I think what DeFi has done in its innovation has shown a new way, you know, through the blockchain technology, a new way to record transactions, sort of a more direct participation by the investors, and certainly quicker, if not real-time settlements. The problem is that there's actually a challenge on both sides. As much as the regulated banks want to sort of enter the space, the DeFi protocols would love to get access to the regulated entities' monies that they control, because they're in tens of trillions of dollars, whereas the DeFi is currently at billions. But the reality of it is it's not just regulatory. I think it's mentioned on the clients. It's the fiduciary responsibilities of these institutions. You go through an intermediary, and you're using a product in a certain market, and you have recourse and legal accountability. Whereas open source public blockchains with very limited resource through your you know, market access, the protocol itself, and then ultimately on Ethereum or other layer 1 protocols. I think the opportunity for the banks is to actually create a regulated network. I mean, DeFi, although they're doing innovation around reporting and settlement, are really recreating, you know, market making, yield farming or interest. They're not doing spread-based lending. They're doing sort of total return swaps without the Delta One hedge. So we could recreate everything in DeFi and more if we had a regulated network, and that's one of the things we're targeting with digital exchanges. So anyway.
So what I wanted to do, though, is kind of provide a bit more framing or retort around the idea of risk aversion, right? Which is the thing that is really interesting to me, is that you have to kind of look at this as a set of incentives, because I think William actually pointed out very astutely that it's really risk around asset class, right? And the reason why I want to point this out is because risk reward has always been a natural behavior of banks, right? And if you go back to Lehman Brothers in 2008, there was this pursuit of like CDO squared, and this kind of like extreme kind of mortgage-backed securities and derivatives, right? So in a sense, like, you know, there wasn't risk aversion there, right? And you know, but in a sense, there was this idea that they were operating in an asset class, right? So in a sense, it's sort of like, right now, I think it's categorical. And when you think about this kind of feeling, it's really more social, and it's about incentive alignment or misalignment rather than actual risk, right? Because to me, the thing that's so interesting when you think about risk reward is that, you know, the risk is sort of categorical in the sense of like, oh, well, you did DeFi, or you did blockchain, or you did, you know, so that the idea of categorically being over there suddenly exposes you to potentially criticism, you know, censure, firing, whatever, so there's a lot of kind of like implications around this, but I think Paul was mentioning things like, market making and liquidity. Like one of the mechanisms that we're seeing for, traditionals is, we're actually seeing, like, for example, the $1 billion plus investment that Sequoia and Paradigm made into Citadel is noteworthy, right? The reason why I say it's noteworthy is that, Citadel isn't really, banking, but it's traditional finance, right? And the thing that's interesting is the thing was made at a $22 billion valuation, right? So if you look at it from a VC perspective, it's like, oh, Sequoia, how much, what was the valuation of that startup you invested in, Citadel? Oh, 22 billion. Okay, how are you going to make venture returns on that, right? So my point is you have to scrutinize a deal like that. And I think if you look at a deal like that, what you're going to see is traditional depth of liquidity, but potentially, crypto yields, right? So I think that this is a kind of a frontier partnership. It's obviously not traditional banking, but it's traditional capital. I mean, Citadel's big.
I would definitely agree with that, Miko. And I see this in while I work directly with Celsius and enable a lot of their DeFi products to come to life. They provide this centralized user experience where you can log in with simple email and password and use your debit card and credit card. So kind of this, exactly to your point, traditional liquidity that they're tapping, but they're getting the DeFi yield. So they're using DeFi rails in a way to provide large amounts of yield to their end users, and also removing the complexity that is so abundant in today's DeFi experience.
I think it's funny, right? I mean, obviously, I'm a long time, 2017 era advisor to Celsius, as well as our firm invested in there early. But like, in terms of like something like CeFi, the thing that's so funny is if you have TradFi getting access to DeFi through CeFi, right, then we're really talking about kind of layer after layer of intermediary, right? So, we're definitely seeing kind of like the reassertion and reemergence of like mass intermediation, which is of course something that, Satoshi was trying to get rid of. So, it's in a way like the layers of intermediation kind of are, a mechanism for re-injecting, trust at some level. So it's a funny reversal of the original paradigm.
I've often sort of made the case, if you look at centralized or traditional finance, you go through a broker, an intermediary to buy a product that's centrally cleared. Well, if you look at DeFi, you go through MetaMask to talk to a protocol to get settled on Ethereum. So structurally, it's actually, similar. It's just that they're in decentralized settlement mechanisms. But I think the big banks, the trust banks, are dipping their toe in the water, merging with crypto custodians to offer at least buying and selling of crypto assets. The challenge with the DeFi is, what we mentioned, some of the hacking, the security. You can legally front run or spoof some of these protocols, or rather, it's not illegal to do it, I should say, right now. So that's the challenge, and that's where I think DeFi has either got to get those controls in place, or the regulated entities have got to create it. The interesting point, though, with the distributed ledger technology, and I think this is the opportunity, is it's actually creating a greenfield opportunity for new competitors. It's completely opened up the lower cost of entry to the market. And a lot of network companies, whether they're telephone, social media, retail, could enter this market with banking licenses or brokerage licenses and create a regulated DeFi. And that's where the traditional banks have got to be careful.
Yeah, I agree. One of the reasons why we see value in DeFi is disintermediation to make transactions faster, cheaper, programmable, automated, etc. You see certain possibilities in payments. You can get rid of correspondent banks. In DeFi and lending, you will still need to have a lot of intermediary parties. And indeed, the way that you say, okay, is the good thing about DeFi. Again, competition. That's there is not that much power with certain centralized parties. Although within DeFi, you see a lot of intermediaries who are playing a role and which are that role is very centralized. If you see API providers, stablecoins, they're very much centralized with several parties. But indeed, that's the challenge for banks to still continue to play that role and to be able to fight towards to safeguard our position towards new incumbents, which we're already doing for a long time with fintechs trying to grasp us. Indeed, agree.
Yeah, I think it just really comes down to the DeFi experience as is today is extremely cumbersome, and you have to be very well educated in what you're doing, or else you are privy to almost an endless risk vectors, like controlling your keys, controlling your wallet, transitioning tokens across chains. This is something like I'm not going to be able to educate my grandmother on, and her just magically be able to do all things DeFi. And she's a very technically savvy person, always has been. So this is why I'm pretty passionate about CeFi or CDFi and the blending of these two entities, because the education process is just such a steep learning curve. For instance, even if you do know what you're doing, you could go to a bad protocol, and if you don't understand the ins and outs of how the protocol was built or who was behind it, you could get rugged, or you could have your funds stolen from you, and that kind of thing.
Yeah, no, I think there's a lot of technology around the interface, and I've listened to a couple of the earlier panels over the last couple of days, and usability is a big issue, which I think you mentioned before, which was the banks or someone like Citadel. If they can provide those intuitive interfaces, then that's the opportunity. Definitely one of the pluses that needs to happen in the industry.
Yeah. So I think both William and I have kind of mentioned something like a Celsius, right? There's obviously other apps in that kind of category, but like in a sense, I think the critical factor there is custody, right? But to me, the thing that I think is so essential is really focusing on use cases, right? Because in a sense, like use cases, to me, when you think about self-custody, right? Self-custody is the sort of purveyor of complexity. Right. So a lot of the complexity goes away if you have custody. Right. But of course, if you read the Satoshi white paper and you read the abstract, he literally says the majority of benefits are lost if there's a need for a trusted intermediary, right? Which is exactly what a custodian is, right? So in a sense, like it's sort of like, okay, the innovation of Bitcoin is gone if you reintroduce a custodian, right? But then you get ease of use again, right? So so it's really like this amazing kind of conundrum. But from my perspective, the thing that I think is important that people should realize is they should really realize what their optimal set of use cases is, right? Because when you think about self-custody, I think the optimal use case for self-custody is sort of what I call a hyper-adversarial case, right? Which is if the government and the banks have colluded against you, maybe you're exiting your country, maybe your country's in a weird war, dictatorship, so like, and a lot of us who live in, fairly established countries don't have those problems as frequently, but these types of use cases are ones where if you do have to exercise this use case, like you're in a really bad spot. So like, if you look at it from that perspective, then like it's all based on risk and reward, right? So, if you look at this very extreme risk, then you might want to have a little go bag with like a little bit of Bitcoin in it, and self-custody, right? But obviously that exposes you to hacking risk, right? So in a sense, like, I think what people haven't necessarily done is kind of created a complete kind of inventory of risks and rewards at the consumer level and kind of given people a way to navigate that, or a logical way to figure out how to diversify their risk, right? How to put a little bit of here, a little bit in this pocket, a little bit in this pocket, right? And for most consumers, it's too much anyway. Like most consumers shouldn't have self-custody of anything. That's my assertion.
That's the thing. Self-custody can be possible. A lot of people compare, okay, money and finance should be as seamless as sending pictures or something like that. But the difference is, yeah, if you lose a picture, who cares? If you lose money and if you lose your life savings, yeah, then it's a problem. Then you need to have somebody to go through. Then you need to have somebody who safeguards your keys, that you do not lose your passwords and anything like that. So self-custody, ideally, yes, you're not dependent on anything or on anybody. But yeah, if it goes about your life savings, then you do want to have that dependence, and then you want to have that trustworthy partner that backs you up when things go wrong. So yeah,
we've looked at this as a explaining this is the future state, in the sense that the nodes may be the institutions may be transaction hosting services, even if they're not your custody. You've got the concept of an asset has to be perfected somewhere. But if it's issued digitally to the network, it's effectively perfected in that network and therefore can transact. And as a participant, you could be having self-custody, even if you're going through an institution to actually participate in the network. That's going fully digital. So in the same way the depositories took paper assets and then turned them into electronic records, eventually you could issue electronic bonds and equity without having to go through paper. Well, we've got an interim state where we say, okay, immobilize an electronic record and issue it as a token on a digital network, and now you've got a transition. But eventually, securities could be issued digitally to a network, and the issuer and the transfer agent are literally nodes on the network just to participate in the securities, you know, when you pay dividends or interest or any corporate actions. But the actual participation of those networks is a user going to a hosting service. So you get to the internet through an internet hosting service, and then you participate as an individual on the internet. Imagine going through a transaction hosting service to then be that self-custody. So it's definitely and we keep telling the banks and brokers, the assets are becoming digital meaning on a distributed ledger or a blockchain. So that's the future. You've got to come and kind of get with the program.
Yeah, I mean, I think, go ahead. I just wanted to provide a little editorial framework, right? Which is we're in the Global DeFi Conference, right? And the thing that I think is fundamental about the idea of the D in DeFi and decentralization is it dependent on self-custody, right? So in a sense, like you're not, you know, if you're not in self-custody, you're not doing DeFi, right? So it's you know, at the moment, there's quite a hard line there. The thing that's very interesting is actually increasingly how people can get exposure to the alpha by surrendering custody, right? So that, you know, in a sense, like when you look at CDFI, as William pointed out, right, there may be ways where you're like, I like the yield of Aave, right? So I would like to have a custodian give me the yield that comes from Aave, and, you know, let them have their margin, like let them have a small amount because they're holding custody. That's a service. I want that service because I want to sleep at night. Like, I don't want to get wrench attacked, or I don't want to have any problems, right? So like, you know, it feels like that's definitely a thing, you know. But you know, I'm happy to pivot if people have a gripping topic.
Well, on the one hand, the self-custody indeed, because you need somebody to safeguard your money. On the other hand, regulators also want that everybody gets KYC, that they know who is doing what, that transactions are being screened, that there's no anti-money laundering. So from that point of view, you also need to have some kind of identification that could be done by somebody who's keeping custody of your identity, or who is at least doing KYC. So yeah, on the one hand, you need custody from a safety point of view. On the other hand, from a regulatory point of view, because currently definitely AML, and you see that in regulation, AML is a big topic for the moment. And even the incumbents providing wallets, they are already doing what is that, passport, the traveling rules, so that everybody is meeting that. So from that point of view, that's a logical situation, and it could be banks that are doing that. It could be the new incumbents that are doing that. The wallet providers, they are doing that.
I can concur with that in the sense that every transaction usually involves some form of legal relationship. But again, the self-sufficiency of how you control your assets versus the legal entities that you go through to get that, you know. But I agree with that sell them.
So I'd like to throw it over to William, because I know that ChainLink is actually doing some really novel work with zero knowledge verifications, right? So to me, like when you look at the role of ZK in the context of things like identity, you know, it can be very useful, right? Because you can basically generate proofs, right, and assertions that can be backed by like trusted and regulated institutions about the existence of government IDs, right? But then at the same time, you can also preserve privacy, because in a sense, like you can have privacy preservation, because I can go to the dark web today, right this minute, and I can buy a file using Bitcoins or whatever Monero, you know, with 8 billion name password pairs, right? So like, you know, the idea that a hyper adversary can access things like your social security number, your home address, and worse, right? Like this is not good, right? So in a sense, they're actually reasonably legitimate applications for personal privacy. You know, and so the point being is that the government needs to meet their needs, you know, and the user needs to meet their needs. And so like, you know, I'd love to have William talk a little bit about kind of zero knowledge, ZK snarks, ZK proofs, and like talk a little bit about identity in that context.
Yeah, of course, would love to. I think it really boils down to usage and adoption boils down to trust, right? So if you want to go full crypto blockchain, then that means you're not really trusting anybody. And when it comes to actual transaction time, if you trust the party you're interacting with, you'll do it in a centralized way. If you don't trust them so much, you probably do it in a decentralized way. Now, in terms of how we're seeing, you know, here at ChainLink, what we've been working on is travel rule oracles, or AML and KYC oracles. And this is allowing the emergence of permissioned DeFi markets. So once you log into an application, you will be able to tap into this utilizing the travel rule or KYC oracle. They would be able to identify that you are who you say you are, but in a private, privacy preserving way. So we have a product called Deco, which allows for off-chain communication and verification of a zero knowledge proof. And as it rolls up to the blockchain, you get to preserve, which is a you know, a public ledger. You get to actually preserve your anonymity and your actual kind of identity information, such that you are allowed to access the permission DeFi market. And I would guesstimate that if I am a traditional regulated entity and I'm starting to venture into the DeFi space, we're gonna route through this permissioned DeFi market. This way, I'm allowing my user base access to DeFi, but I'm still doing it in the boundaries of the KYC, AML, travel rule laws that I operate my entity in.
Yeah, I fully agree with that. I think that is going to be a vital component of the DeFi process or of the DeFi evolution, as it combines, it provides privacy towards the users, but at least it also enables identification to the people that need to know it. And ING has been working on zero knowledge proofs and zero knowledge range proofs already since 2017 as well. We in 2018. One of the first presentation of my DLT developers was zero knowledge proofs on Ethereum, and we got congratulations from Vitalik Buterin at that time. And then we expanded with zero knowledge range proofs and trying to find application on other platforms as well. So yeah, what you're saying, William, definitely, I think it will be a vital component for the further evolution of DeFi.
Okay.
Yeah, I'm excited to be having this conversation, because, you know, in my perspective, when you look at the serious people in crypto who don't know better think the SEC is like scary and serious, right? And like the SEC will come sit on your business and your business will go away. They'll put a fine on you, you know, and like these things will happen, right? In egregious cases, they'll bring you to court and maybe try to put you in a jail. Egregious cases, right? But like the people that you really want to worry about are like FinCEN and DOJ, right? Like if you're doing AML stuff, like they're definitely going to pick you up. They're going to put you in handcuffs. They're going to put you in a prison, and they're going to show up with guns, right? So like, you know, in a sense, like, you know, the really, really non-negotiable regulators are absolutely kind of like FATF, FinCEN, like, the Treasury, like all those are the characters that I that's non-negotiable, right? That's heavy stuff. So like, I do think that, one of the recent incidents that I think is fascinating is the Axie Infinity Ronin bridge was hacked, and that the reports are that it was hacked by Lazarus or related entities, state actors from North Korea, right? And one of the actions that was taken is a popular Tumblr, I think it was Tornado Cash, actually blocked the hacker wallets, right? Which I think is such a super interesting extreme case, right? Because what you have is Tornado Cash is fully decentralized, right? But is it really? Is it really fully decentralized? Because if it were, like, who exactly is it that's blocking this wallet? And who generates the list that blocks the wallet? And why do they generate that? Is that list generated by like a consensus of all the token holders? Like, I don't think so. Like, somebody agreed with a regulator and blocked the wallet. So, we're definitely looking at very interesting cases. That was a very interesting case.
Can I just go back? Just not to put a damper on the thing, but the cautionary thing was zero knowledge proofs. Obviously, the prominent example is Zcash network, and if everyone looks up how they created their original private key and the lengths they went to keep it anonymous or confidential, destroyed, so no one could ever find it out. Was hugely significant. And remember, a zero knowledge proof is only as good as that private key. So if that private key is discovered, I can log on to the network and I can look like William Reilly to Jan Lebbe, and it's there's nothing that they would know I was any different. So that's we've got to be a little bit cautious with that. That's where I think there's always going to be a role in terms of, like I said, a hosting service, because then you can actually put a completely confidential barrier. Your counterparties know who you are, but the network and your host knows who you are. But I'm just putting it out there.
I definitely appreciate the point you're making, right? Because one of the things that is a flaw of any computational system, obviously, one of the big ones is the Oracle problem, which William is working on, right? Which is bringing off chain onto on chain, right? But the other problem that's so interesting is this concept of like provable deletion, right? Which just doesn't exist, right? Like, you can never prove you deleted anything, right? So, I deleted the key, except I didn't, right? So now there's the backdoor for everything, right? So I totally agree with you. That's such a novel case, right? And to me, like, I just want to make sure we're definitely kind of on task here. I do think we alluded to sort of these very large kind of institutional constructs, right? And like banking and, how they're kind of entering the space by proxy. They're entering the space through kind of mechanisms, CeFi, et cetera, right? Like, we're seeing some really funny movements. Like, if you look at kind of the, investors in the recent, I think, $850 million round of Celsius, you're going to see names like, the largest pension fund in Canada. You're going to see, Westcap. You're going to see fairly traditional names, right? We're seeing all the kind of like Tiger and Coatue, and we're seeing kind of like more and more traditional looking names, Apollo, Citadel, so it's all starting around the edges. I mean, that's my feeling.
Yeah. And Apollo is going to be even more into the blockchain space now that they have the digital head of JP Morgan joining them.
Exactly. That's it. So, I definitely want to keep us all kind of up on the latest. And there's kind of news every day, right? So a lot of more credibility, legitimacy, and, I do think that everyone here seems to be in agreement that regulatory clarity is not here, right? And, so obviously for the mainstream institutions themselves, like, yeah, this is not a thing, right? So to me, everything has to be done via like proxies, right? So through investment arms and through kind of these mechanisms. But to me, if you think about it from the perspective of liquidity, and you think about it from the perspective of beneficiaries, right? Like, end users, like, customers of Fidelity who can do 401k with Bitcoin, like, they're beneficiaries, right? Obviously they have intermediaries, but to me, the beneficiaries and the liquidity provisioning, like if you're using Celsius, like you're using DeFi, like, indirectly through the mediation partner, right? So I think that pattern is already here, right? So the idea that like, oh, because the point is it's less about the traditional banks as institutions per se, and it's more about the scale of liquidity. So the question can be like, can the scale of liquidity, enter without necessarily the institutions themselves incurring the kind of direct risk?
Yeah, Matt, liquidity, yeah, it is inherent of DeFi that liquidity will normally increase because of fractionalization of assets and digitalization of assets, enabling all the same people to get access to the same kind of investments, to be able to buy a fraction of art, a fraction of a new house, fractions of loans, etc. So that is going to increase liquidity. One of the other things about DeFi reduces the entry barriers, DeFi reduces the exit barriers, that secondary markets are being created, making those assets more liquid, enabling people not to lock their money into something for a long time, but that there are secondary markets that they can liquidate directly that digital piece of art that they invested in. So from that point of view, yeah, that's intrinsic about DeFi and the promise of DeFi, the democratization of finance, the increase of liquidity. Yeah.
Well, that's the interesting challenge in terms of getting either real assets or legacy debt and equity or derivative assets into a DeFi protocol. I think one of the challenges with the DeFi tokens, and this is where they're operating outside the traditional finance, and I mentioned this before, is that a lot of the returns are determined by asset appreciation, which is just because they happen to be new and they go up in price. And that's not necessarily sustainable. So, and there isn't really spread-based lending or active markets that generate real returns. At the moment, it's either a diminishing return or a zero-sum return in some of these markets. So, but the opportunity to get real or structured assets in digitally issued, that's where I think the real opportunity is going to be in the future.
Yeah. So I guess one of the things that I've been really thinking hard about, right, is I spoke recently at the Cornell blockchain, and it was very much the same topic actually. And one of the which is really about kind of the movement of the traditional, right? So I think the thing that it becomes really fascinating is that, like, banks have customers too, right? So the thing that becomes so interesting is what do the bank customers do, right? And in a sense, the pressure on the banks is proportional to the extent to which their customers kind of directly engage, not necessarily like go, ape a bunch of DeFi protocols using MetaMask, but more so, how they get exposure to the asset class. Like, I happen to be in the venture capital business, right? And what we've noticed that there's a wall of venture capital coming into blockchain and DeFi and so-called Web3, right? And in a way, like, it feels like there's a number of folks, traditional venture investors, but even new money, like family office, high net worth individuals, that are actually trying to get access to blockchain by hiring managers that are more venture class managers, right? But that may be representing a shift, right? Because so they may be actually increasing their portfolio in the venture segment, but they may be doing so deliberately to get access to a managed portfolio of blockchain assets, right? So that's an approach. But we are seeing big funds. We're seeing like Katie Han. We're seeing obviously like Apollo, Koku, Tiger. The bigs are coming in, like the Heavy Capital, Golden Tree. So it's that's a thing, right? So bank customers may be bringing liquidity as opposed to just the banks.
And the pressure to participate.
Yeah. And the question, bringing all these digital assets on chain, Deutsche Börse is trying to do that, as the X is trying to do that. For the moment, it's still work in progress. A digital version of a diamond, digital version of gold, digital version of art. Before getting that on the blockchain, it needs to be verified. There needs to be again a party that verifies that asset, that says, okay, this is that asset that is traceable, etc. So it is maybe also a little bit easier said than done, that you create massive liquidity of all these new digital kind of assets.
It is difficult, but there are routes. So for instance, at ChainLink, we have a solution called proof of reserve. So we actually validate off-chain asset classes, and we allow those via our data feeds Oracle to mint these assets on chain. We have multiple examples of this. For instance, we have proof of reserves around gold vault reserves. We work with third-party auditing services that do real-time attestation and auditing of these vaults. We also have, same thing for assets stored in bank accounts. We're working on proof of reserve for carbon credits, as well as we're venturing off into real estate assets. So the value of real estate, maybe a basket of properties that represents ownership right tokens or investments, fractionalized real estate is pretty much what we're unlocking with this proof of reserve solution.
That sounds like a similar. We have what we call our airlocks, which act as the entry points for, we said, like in the same way depositories immobilize paper and create electronic. We can track a legacy asset and then digitize it to be transacted in the network. The real thing of the innovation I mentioned at the beginning is the fact that, we've had real-time trading for decades, but settlements are made 1-2 days later, and there's all that friction and acceptance processing. DeFi has shown the way, but the real requirement for an active market is to get to real-time settlement, which is where, some of the protocols, we're talking about getting consistency without the need of consensus, so you can get the speed through.
But the other thing that's, go ahead.
Yeah.
Go ahead.
Yeah, and settlement and central bank money, that is the key, and that is something that banks are working on, that Finality is working on. So
that opens up Pandora's box of fractional reserve accounting and identity and everything. Not impossible, but it's a challenge.
Yeah, but thing is that you need to have as much money centralized to create that wholesale CBDC or wholesale CBDC like thing that settles on all kinds of transactions, and not the fractionalization that you currently also a little bit see in ECB, where you have target 2 with TIPS, T2S, and RTGS settling various kinds of financial transactions.
One of the fascinating things is really kind of the use of liquidity, right? And this kind of mechanism, particularly as you kind of understand sort of things like confidence, utility, price action, right? So one of the mechanisms that's kind of really becoming intriguing close to the Ethereum merge is really kind of the Ethereum staking mechanism, where people secure the network, right? And so in a sense, when you think about this from a mechanism perspective around central banking, right, the idea becomes that like you have sort of a decentralized central bank, right? And that the idea of staking is really the idea of, at some level, sort of a furnishment of liquidity, right? So in a sense, like you have a more decentralized furnishment of liquidity, and you actually have mechanisms that are contractual that enable you to sort of, regulate the flow of liquidity, through, because in that model, everybody becomes a bank, right? That's sort of obviously it's kind of inspired by the Bitcoin model, but of course the Bitcoin model doesn't have staking, right? So it's that's the further evolution of the decentralized central bank.
Yeah, I totally agree with that, and I think in the end it will be a coexistence between centralized entities and decentralized entities, and you'll go to the centralized islands and they will all communicate via decentralized rails. So when you really need to have sureties in your settlement process with parties that you may or may not trust 100%, you'll go and tap into those decentralized networks, and as the centralized entity, you'll be running nodes and be prepared to participate in the validation process.
I think in looking at kind of long-term commercial applications, right? Like one of the amazing things, if you study something like the API economy in history, right, you end up looking at things called web services gateways, right? Which basically count developer API REST calls, right? And then they send an invoice, right? That's net 30, and it goes to accounts receivable and accounts payable and all this kind of like really absurd kind of stuff that relates to what Paul was saying about real-time settlement, right? And kind of so-called fast finality, right? But the thing that's so interesting becomes that the goal of all financial systems should not be immediate finality, right? And the reason why I say so is that there was that wonderful flash loan governance attack that we recently saw, right? And so in a flash loan governance attack, it's sort of like, oh, the community in the form of a single wallet has voted for itself to commandeer the entire contents of the vault, and it's sort of like, if you settle a transaction like that, maybe a little more slowly, like there might actually be some form of like recourse checks and balance, right? Like there might actually be sort of a way to convene more stakeholders, right? Because obviously if someone flash loan attack, right, like obviously they could attack again using the identical mechanism, right? But at least the community's watching, and the community can be like, could you give us a couple days, right? Because in a sense, it's like we're transferring the entire contents of the vaults out to a single wallet. Like we might maybe want to put a 3-day delay on that, and then you're back to like ACH, right? Like, it's like, oh, we're waiting for 3 days, but like, should we be angry about that? Like a 3-day delay, like it actually might be a good thing.
Well, that's more a fault of the code than real-time settlement. But the reason,
but what I'm saying is that delayed settlement may actually mitigate for cases where the code is flawed. And I think you can't just say, don't write flawed code ever. Like, I think that's not a good answer.
No.
Delayed settlement also improves liquidity needs, because then you have more time for netting. So from that point of view, but I think the ideal thing is that you need to give your customers a possibility to either.
I think we're getting delayed settlement.
Yeah. Well, we operate with payable receivables as well, so we can actually record the obligation to the ledger, and then that allows counterparties to net and settle over greater amounts of time. And usually, because as I say, a bank or broker, he or she will sell you something they're about to buy, about to get back from loan, or about to borrow, and your money is tied up in a money market fund. So once you've executed a trade, you cannot settle it in real time. You may have to record the obligation and then settle it when the monies are arranged. And that's one of the challenges with any DeFi protocol, if it really gets sophisticated, is to do that intraday financing and netting. That's a key functionality that's often overlooked.
Yeah, and I think one of the ironic things too is watching the evolution of DeFi services. Paul, you mentioned fiduciaries, right? Like, we're talking about introducing delays in settlement. Like we're talking, so the thing that's so ironic and funny, right, is to watch people who are sort of reinventing the wheel kind of eventually evolve systems that already exist, right? Like that's an incredibly there's something kind of entertaining about it. I would imagine if you worked at a traditional financial institution, you might feel a sense of amusement.
Delayed settlement, okay, it has its benefits, but what is important, you need to be able to settle whenever you want. You need to be able not to have any hurdles if you want to have instant settlements. If you want, ideally, if I want to trade at a certain time, if I want to give my share in Unilever or anything like that to somebody else, okay, that should also be possible to be able to transfer to another person. So you need to, be able to do whatever is possible without having any barriers. If that's instant settlement, if you say, okay, it can take a day or two, allow it to do it, but make sure that there are no barriers, that you can do whatever you want at any time. That is one of the promises of blockchain and disintermediation, etc. So,
which is why I don't think there will be a winner take all in the blockchain space. Not from a protocol level, not from a blockchain level. I view it more as a harmonious tech stack that you will use based upon use case and need. So there's a lot of folks in the blockchain space that are very stuck on one community, and they think that community will win all there is to have in DeFi, when ultimately I think it will be a case-by-case basis and what you're actually trying to accomplish. So in these events that you need a time delayed period, I think somebody will probably invent that wheel in DeFi, and then it'll start being used. And then when you need something super lightweight, it could be, and fast and instantaneous, it could be something like Solana, or even something more funny like Doge. So
I mean, here's what I love on this note, and I know I've got to wrap up soon, so I just want to let anyone chime in after me if they want. But like, to me, what I love about the tone is that you're really talking about freedom. And the thing that I think is delightful about the way you described it is you really said, like, if people want restrictions, they should be free to get those, right? They should, if they want delays, they should be free to get delays, right? And to me, like, what's wonderful about it is that, there's a form of freedom that people kind of conceive of where they think there are no rules, right? That they think that freedom means that they can do whatever they want. But like, what if you want rules? And that's of course like the right mindset. So, I think, we are moving towards I think synthesis, and I think William really, capstone this conversation well, which is that, we shouldn't reinvent the wheel, but at the same time, like, we can kind of find this beautiful, happy medium between, what the traditionals have done beautifully well and what the innovators are doing, to kind of maybe improve on that. Any other closing comments from anyone?
I would just quickly add, within the regulations, if two counterparties, they can agree any settlement. Market practice may dictate a certain time frame, and obviously people follow it for financing reasons, but actually two counterparties can agree any settlement time frame they want to, which is why you have cash trades, meaning same-day trades, and so actually the door is open. We've just got to walk through.
That's great. Well, good. I realized we were asked to do something very impenetrable, which is to talk about traditional banking, and I think it's a tough nut to crack, but I feel like we did a nice treatment, and hopefully people got some good value. If there's any kind of final 2 bits, please throw them in.
Last thing, just pile on to what you said, Miko. I think, long story short, it's not about winner take all. It's about allowing freedom of choice, or a broader set of options to choose from.
That's right. Terrific. Yeah. Good capstone.
Amazing.
And it's
Thank you all so much. Yeah. Apologies about having to cut you off now. We've gone a few minutes over there, as Bill was pointing out. So thank you all so much for an amazing panel. So much to think about. Really appreciate all the contributions, and definitely a lot of value for people.
Wonderful. Thanks so much.
Great. It was good fun. Thank you.
Thank you, everyone.
Have a good evening, everybody, or day.